Works. Alright, we're going live. Okay, I think this is on. We're live. I hope this isn't double voicing, but I'm sure somebody will let me know if it is. Sip of my Tiracha. So, first up, thank you for joining us. What's up? What's going on? Figured I'd do this live, so we're going to do the video this week, and I was going to do some of Warren Buffett's sleeves dividend stocks that he has in his portfolio that are trading at a discount, meaning that they are currently above their 5-year average dividend yield. And we're going to do this using Simply Safe Dividends. But before we do that, take a peek. We're going to take a peek at our bridge portfolio. And again, using Simply Safe Dividends, really cool site here. And inside the bridge, I want to point out that we did buy Pepsi. So really interesting. It's currently 65,464. That is the Schwab number up there I go by. So close, a little bit off. Annual income 2459. And the way Schwab does it is they project it. That's what the PADI means, projected annual dividend income. Charles Schwab will project out what your next 12 months are going to be, that's what the PADI is. Really interesting here. You can see there's income calendar. Our next payment is going to be from Cisco. Click on that real quick. $9.99. So I have a bunch of different accounts in here. So really interesting. It'll break them out. And we can see Cisco is going to be 37 cents a share for the low price of $9.99. And let's go look at Pepsi, by the way. We'll look at the percent of account. So it's really gotten big. If you're not familiar, I have started back 84 weeks ago now. I wanted to buy 1 share of Pepsi a week to get to 100 shares so we could hit 100 and start selling covered calls on that and start making some more income with PepsiCo. And it's gotten to be 22% of this portfolio. That's a little big of this account, but hey, it's okay because Pepsi, as Simply Safe Dividends shows, 93 dividend score, so that's very safe. 2.47% yield, not world beating. And I do hold Pepsi in 2 accounts. Well, the second account is my daughter's, so they'll combine it all there and show the annual dividend income. Very interesting. So you can see it's growing nicely. This is our bridge portfolio. But what you're here for is the Warren Buffett portfolio. So on Simply Safe Dividends, if you go to ideas, they will show you Buffett's portfolio, Gates's portfolio. They got a lot of nice ideas in here, but we're going to focus on Buffett. Now, these are just his dividend stocks. Inside of his portfolio, there's 27 companies that currently hold dividends. And yeah, Pepsi, I'm not going to chat back. So I can see what you guys are saying. I got it pinned right there. And I hope hope it sounds good. So let's dive into it. The very first Warren Buffett stock that's on the list. How about we do this so it doesn't, I gave away a little bit of it there. We'll just scroll up with it, yeah? So first is Sirius XM. To hell with it. First up is Sirius XM in the communications sector. So we know Sirius. I used to have Sirius. I don't know if, yeah. Oh, dude, crypto dividends, Mike Muir. All I wanted was a Pepsi, and she would give it to me. Just one Pepsi. Love, for those of you not in the know, that is Suicidal Tendencies. Suicidal. Great company. No, great band. Freedom Stacker, what's up? So, all right, Warren Buffett. First up, Sirius XM. I used to subscribe to it. No, actually, I do subscribe. I got in on the lifetime subscription. I think I paid like $400 for it, and then that went away. But that's on this little head unit, and it was just a pain in the butt. So it's in my new work truck that I got. We're going to be using that. They say it's currently 79% above their 5-year average. Now, it's funny. I don't think of Sirius XM as a dividend company, especially a dividend growth company. They've grown that 50% in the last year. So in October of 21, the PE ratio 19.1, so that's below their 5-year average. One thing I love that they do right here is you want a dividend yield that's above the 5-year and the PE below. So that's hitting on both. And if we click on a Sirius XM, then let's just go down and look at the valuation of it, where you can see that it's really nice broken out here, that the current yield is only 1.46%, but they have been growing that like a beast, as you see. Just a massive jump up. So really interesting company that I don't think about as a dividend growth company is Sirius XM, and they give it a 61, score of 61 out of 99. I guess not 100 because, hey, anything can happen. And yeah, I don't know if Sirius XM, do you own it? Would you own it? I probably won't because it's a small yield, and with so much free content from YouTube and Pandora, Spotify, which also have their subscriptions, I don't think so. So that is, yeah, 50% though. Can't argue with that dividend growth. Next up for Warren, let's hide it. Let's surprise you if you're watching this. Next up is U.S. Bancorp. I'm not a banker. I don't bank at U.S. I'm not a banker. Did you guess? I've never banked at U.S. Bank, but I do see them all over the place. So Warren Buffett does have U.S. Bancorp. Again, these are all his dividend stocks. And they currently say it's 16% above its 5-year average for the dividend yield, which is pretty stout, not as much as Sirius XM. Nice yield, 3.34%, as most of the financials do. And their PE, 12.6, in line with the 5-year average, 9.5% dividend growth. And if we click on the maybe undervalued, it's just a little bit over, 16%. It doesn't look as much on that 5-year graph. Burke B, no dividend, Mike in Milltown. You know what? That's something I probably should do. That's a great point. You don't have to buy individual, but oddly enough, Warren Buffett doesn't like to pay dividends because he thinks they're tax inefficient for us, the investors, because they're taxed once at the corporate level and then they're taxed again as our income. So he would much rather just buy back shares and allocate that capital into growing the businesses and again, you're not taxed until you sell. So he'll probably never sell like Coca-Cola because he's up so big on that. It would be a massive capital gain. So kind of cool to think that. But anyway, so U.S. Bancorp is going to be paying out 46 cents a share. Nice little dividend growth that they've had. And what was their years? 12 years is the uninterrupted dividend streak for U.S. Bancorp. I like what Mike, you got me thinking now, Mike. That's, yeah, you could buy Burke B, but if you're somebody that wants to live off of the dividends and you don't want to have to sell, like somebody like me, then that's also an option too. And yeah, so I like it that on Simply Safe they have the recession sale, and they show that they actually didn't grow as well during the last 07, 09 recession, which I wasn't outright investing individually, but anyway, 55 of a dividend safety score. So that's something, you know, I might consider investing in. If you invest in U.S. Bank, let us all know. And what do we got next? Let's jump to the next one. Oh, you know what? Let's actually look at this. Really cool is I love to see share buybacks. I didn't look at this with, let's see if they got it. I don't think they got it. Return on equity. Here we go. Shares outstanding. Look at that. Boop. Just a slope down. Looks like they tapered off a little bit. FC Bayern München. I know Munch, I'll butcher that. It's German. Hey, appreciate it, brother. Thank you. So let's look at Sirius real quick because I didn't look at that. Sirius XM will go to the, where you pop up? Come on. Where is it? There we go. Weird that it didn't pop up. There, let's see what they've been doing. Look at, yeah, they've been buying back shares too since 2012. Pretty steady, no increases. Currently at 4.21 billion shares. Hey, that's a bit. So interesting. So again, Buffett likes those companies that are buying back shares. Next on Big B, I gave away the fourth one, is Visa. Visa, I have a little bit of trouble with because of the whole DeFi movement, and I think they're big enough, though, that they're not going to be as affected. 99 of a dividend safety score. Let me get a sip of tea from my, look at this, my John C. Stennis mug. What am I saying? Look at this. I know I'm really small in the screen. Down here, wherever. So Visa, company I should have got into a while ago, but never did. And let's look at them. 0.73% yield. Super safe. They're going to be able to pay that dividend. 17%, they give that very fast. So that's a big growth that they did in October of 2021. And their current dividend yield is 16% above their 5-year average. Yeah, 16%. It's currently their 5-year average is 0.63. So they don't pay a huge dividend, which is one of the reasons that I've never really gotten into Visa. And again, they're a monster with earnings per share, $7. Look at that. They're expected in the next 12 months, $5.91. So earning $5 a share, $6.82 of free cash flow per share. And of course, like clockwork, slightly buying back shares, currently 2.19 billion shares outstanding. And you know, I love it that they put, they just have all these graphs. I'm going to start using this more because it just makes my job easier. And again, 13 years of uninterrupted growth streak for good old Visa. How you guys doing on this Sunday morning? You know, this is, again, if you missed it, I was going to do this as a video, and then I thought, why not try a live stream? What the hell? It's been a minute. We did one that was a disaster about I don't know, last April. So anyway, Visa. Buffett's got Visa. Does anybody hold Visa? Would you buy Visa? I'm not buying it because I want a bigger yield. But again, can't argue with that growth and the chart. Just a nice climb up the dividend growth mountain. The next one, though, Merck. We do hold Merck, ticker MRK. I hold that in a few accounts. Again, they give it a safe, very safe score of 99, 3.45% yield. And looking at this reminds me that I should buy more Merck. They have a few drugs coming. Well, I think the big one is Keytruda, the cancer drug, off the patent cliff. We did that video going over all the drugs that are heading toward the patent cliff in the 2020s. I was going to say 22. But yeah, they take a bit of a ding to their revenue when the biosimilars can start producing these drugs. So that's always something to look out for, is the patent cliff that could be coming. 11.6 PE ratio, which is below their 5-year average, and 6.2% growth in November of 21. So let's start there with the dividend growth. You know, a little bit flat. It's not big growth, and they've had an uninterrupted dividend streak for 30 years, and they have been growing that dividend for 9 years. Again, I like Merck. Probably should be buying more of them. Currently 69 cents a share. Again, growing it nicely. We like to see that dividend growth. They got so many cool things. I'm kind of getting used to Simply Safe dividends. And if you haven't, you can get a 2-week free trial. I'm not hawking them, just you can. What are we going to look at? How about look at share buybacks? I'll bet you almost all of these companies are buying back shares. And again, look at that, $6.87 expected in the next 12 months. Shares outstanding, there it is, 2.54 in the last 12 months. So they may have slowed it down just a little bit, but all the way from 3.09 to 2.54 billion shares outstanding. Again, that's going to increase the amount of shares that, not the amount of shares, that's going to increase the earnings per share that we get as dividend shareholders, as just shareholders in the company and dividend shareholders as well. So what interest coverage ratio, I know I've talked about it. Look at this. So the ICR, I'm so happy they have the interest coverage ratio. I usually go to Guru Focus to look at that. $22.13, that's what that number means. This is how much operating income they have to cover the interest expense. So as long as they can service that debt and pay the interest expense on that debt. So Merck next year, or in the last 12 months, will have $22.13 to easily cover every $1 of interest expense, and they like to see above 8 for most of the companies out there. And yeah, that's pretty cool. Let's go to the top. Nice little card. Let me know what you think of SimpliSafe Dividends. Do you use SimpliSafe Dividends? Merck has a low beta. So this beta, the 0.23, this means that if the market were to drop $1, that Merck is only going to drop 23 cents. But if the market goes up $1, Merck is only going to go up 23 cents. So that beta, that low volatility, is good and bad to both sides. And you can see my shares currently have, where's the share count? 13 shares across a couple portfolios. Or no, one portfolio. It's all in the bridge. And our annual income is currently $35 from Merck. So Warren Buffett and I both hold Merck. And that's Merck. So who's next? Got another pharmaceutical company, BristolMyers Squibb, BMY. What about BMY? I don't own them. I feel like I have maybe too many healthcare companies, and I'm probably not going to buy them, even though I know a lot of people. My buddy, European Dividend Growth Investor, just started a position in in BristolMyers Squibb, but I already have AbbVie and Johnson & Johnson and Merck, and another one that I like that's not on this list is Gilead, ticker GILD. Gilead spun off Organon, which is like women's health. I had a share and a half, or no fractional shares. I had 2 shares, I think. But anyway, I sold it because it was just not going to be a core position. So you can hear my text message. BristolMyers Squibb. You got BristolMyers Squibb. 79 safe dividend score. And the current dividend yield is 14% above their 5-year average. 10% growth in December of 2021. So that was just really recent, last month. There you can see the 52-week price range. Didn't really talk about that. Kind of in the middle, toward the high middle end, but not a huge $53 to $69. The healthcare sector is 17.7%. And let's see what that is. Oh, sorry. It's my wife texting me. And don't tell her we're doing this. The current yield, as we did see, is 14% above the 5-year average of 2.98%. So that's pretty cool. That seems like a good space, to almost 3% for such a big company. Bristol-Myers, again, let's see if our trend continues and stays true. That now, interesting earnings payout ratio, very low, only 27% the last 12 months. Free cash flow payout ratio, that's the number I love to see, 30%. That's what they're paying out after all in reinvesting in a business and all of their bills. That's the money left over, the free cash. Super important number. And let's see. Ooh, now that's interesting. Now, I hadn't seen this before, but they have been diluting shareholders just a bit, going from $1.71 billion in 2019 to $2.26 billion in 2020, but then they did buy a few back down to $2.23 billion. So that's interesting. I don't honestly know what that's about, but again, that's something to keep in mind with Bristol-Myers. So, hey, we broke our streak, Warren. What are you doing, Warren, holding a company that's diluting shareholders? And how long have they been doing that dividend growing for? 14 years, 30 years uninterrupted for Bristol-Myers Squibb. It's crackling. Uh-oh. All right, hold on. Let's see. My audio is crackling. All right. Does Warren own any REITs? I'm glad you asked. Let me see what's happening here. All right, watch this. Because I'm so unsophisticated, we're going to go into the audio. All right, let's see. Let me turn this down a bit. All right, is anybody let me know if that's... All right, I can talk kind of loud, as my wife likes to say. All right, let me know. Is that any better? You can see me right here playing with the audio. I think. Yeah, I think I turned it down. I don't know. Are we good? This is OBS, by the way, that I'm using to stream. This will get better, but yeah, we're going to get to a REIT. Warren does indeed own a REIT. So I'm a welder. That's what I've been doing for the last, I don't know, 20-some years. But I'm learning this. I enjoy this. I'm just love sharing a passion with everyone and hearing people. Okay, better. So I think that was the problem. So if you see that little bar down here, all right, watch this. Maybe I should do, all right, here. Hello, hello. All right, let's get back. If that green, so I know if that little green bar, the yellow's okay, but if it goes red, then it's going to sound like that flamingo guy my kids watch. And all he does is he screams. He screams and it crackles. So, all right, let's leave it like that, huh? And what were we talking about? Oh, REITs? Good. Yeah, it cleared up. It got better. All right, so that was BMY. What's up, my wife? My wife's come down. Just come over here and say hello on camera. All right, good. Thanks, Mike. Sounds all better. Say hello to people. Yeah? Well, you should have told me. Okay. They want you to say hello. Say hello. We were talking about BristolMyers Squibb. Can't see you over there. Anyway, somebody want to know about a REIT. We're not through with the list yet, everyone. I can definitely talk loud and...
Hello.
That's a lot of red hair. Yeah, white. Yeah, they just said white noise if I crank it up. See, they helped me fix it. So we are on to a REIT that may be undervalued. Store Capital, I know people have wanted to hear about Store Capital. So that's a REIT. If you don't know, REITs have to pay out 90% of their taxable income in the form of a dividend in order to maintain that tax advantage status. So the company's not paying the tax, so to speak. We're paying the tax. They're just passing that through. And yeah, that was fun white noise if I crank it up. Good. I'm glad it got fixed. A little bit embarrassing because, whatever. So, get the information to you guys. What's up, Maurice? Alrighty. Store. I'm losing my track here. I'm just going to talk to you guys all day. 5% dividend yield for Store Capital. Just a little bit above the 5-year average. 6.9% dividend growth. And that dividend yield, did we say that? Oh, it's 11% above the 5-year average. Yeah, funny thing, my wife will say I'm a loud talker. It's probably because I'm going deaf from so many concerts and clubs. And when I was in the Navy, when I was younger, I didn't bother using my hearing protection like I should. So I do have that tinnitus. My ears are always ringing. So right now I have it quiet in here, and I love just being surrounded by noise, like that white noise. But not white noise when I'm talking to all you fine folks out there on this Sunday morning. So Store Capital, let's go through it a little bit, see what's up with Store Capital. We'll start from the top, because I've never really dug into it, and I've had people ask about Store Capital. HSA or Roth, those REITs. Took the words out of my mouth. Beautiful, exactly. Because the reason you want to do that is because we're because they're a pass-through entity and we're paying the taxes on that. So those dividends are not qualified. So it's going to be your ordinary income tax rate. But if it's inside of a Roth or a health savings account or a self-directed IRA, then you're not paying anything on those dividends. So it doesn't matter. It's just a little bit of a nice benefit to have them inside of a tax advantage. So 70, they call the dividend safe for Store. Is it Store Capital? I don't see where it says. Anyway, let's see. Dividend yield, 5%. I like that. Realty income is one of my favorites. That's one I've been going big into. They give it a safe dividend. Really cool. I know this is going to sound like an ad for them, but they give these nice little outlooks for the company. As you can see, they do nice little write-ups. It's not on all of them. And then they give notes. Anytime something interesting happens with the company, they will let us know. So this will help me keep more up to date and share the information with you guys. Oh, it is a little bit pricey. It's $399 a year, but you know, it's worth it for me, and I make a few bucks on YouTube, so I'm just putting that into this, and I'll share information with it from you guys, or with you guys on these companies. I love it. I love dividend investing. Their dividend, looks like it was cut from 13 to 14, and it's been all up through there, so that's nice. Let me know if I lost you. My little screen went black here. I'm hoping I didn't run out of battery space. I think I'm good. I'm watching, you see this? Look at, I'm watching the, this is a little preview window that we get from YouTube. And I'm on a 10-second lag, so we're good. I think, there we go. All right, we're good. It's all new territory for me, baby. You know, I'm learning. It scared me. I seen the thing go black, and I'm like, oh no, I'm dead. They cut me out. So, where were we? Oh yeah, so the dividends per share. Talking about those dividends per share. They've been raising them since 2015, the year of our Lord, 2015. Pretty, 6 years, uninterrupted. Still here you find. Yeah, buddy. Nobody told me what yee meant. When I was driving home from work, I saw a sticker on somebody's truck. Good, and it said yee, Y-E-E, Y-E-E. I could have Googled it, but I think it's more fun if people tell me. So if you know what yee means, just, is that when you're excited? You know, yee. I don't drink coffee, I drink tea. Yeah, so what do we got here with payouts? I do believe they pay out, they do not pay out monthly. I thought they paid out monthly. April, July, October, so they're not a monthly dividend company, like a lot of REITs are. A lot of REITs are monthly companies. Again, non-qualified dividends because they're that pass-through entity. $1.54 per share every quarter. I could have read right here. Frequency, quarterly. Maybe if we would just stop and read the words on the screen, we wouldn't have to guess. So, yeah, so their current dividend of 5.04% is 11% above the 5-year average of 4.55%. So they say it could be a reasonable time to invest. And yeah, now the price to AFFO ratio, the adjusted funds from operation, that is what you have to use instead of payout ratio, because they have to pay out 90%. So it's not as good of a metric to use the price, EPS, earnings per share, as a payout ratio. So the AFFO is a little bit below, which is okay, you know. Hey, and look at this. See, I didn't know. 52-week range, $30 to $36. So it's squarely at the bottom of the 52-week range. So, you know, just right there, that could be interesting. Market has been going down as we expected with the rate hikes coming. So, but I would expect that stronger companies, they're going to be a flight to safety like we've been seeing with Pepsi. I just did buy the 84th share of Pepsi. I know I said that at the beginning when I was all by my lonesome, that I'm going to 100 shares, buying 1 share a week, regardless of price. You know, it's just been a fun experiment, and I'll have a wrap up on that. So I bought the 84th at 176.25, I believe, and that was a little bit painful. What else we got here? Shares. Let's see what they do with their shares. Now, a lot of REITs, they see free cash flow per share, $2, so they can cover that dividend. A lot of REITs, they issue shares because they reinvest it to buy more properties, but they should also be growing those, the earnings, the money coming in. As long as they're doing that and they're growing the assets, that's fantastic. So you can see, like most REITs, they have from 18.7 million shares in 2011 to 268 million shares in the last 12 months. That's quite a bit, but again, this is why I'm not terribly worried, because as you see the shares outstanding stepping up, The sales are also stepping up pretty much in line. So that's what they have to do to grow the business. So I'm not that worried. Return on invested capital 4%. I'd like to see that a little bit higher, but it's pretty much in line with what things have been in the last 10 years. And free cash flow margin 78%. That's rent comes in for these companies. They're always got money coming in. That's why they are good investments, I think. So this is something we could dig into a little bit more. Interest coverage ratio, just good enough. And yeah, does anybody own Store Capital? What do you think? I think they look really interesting. They have a nice yield. I like that. So hey, Warren Buffett owns Store Capital, so maybe it's something we should look into. Oh, a word on that. When these hedge funds, these big $100 billion plus, that's when they have to file that the disclosure with the SEC. Always take that with a grain of salt. So all this stuff we're looking at, this is what they had on a snapshot of that day that they had to disclose the information to the SEC. How do I feel about REITs and any of their leases coming to an end with companies? That's a great point, and I think the office REITs are what you have to be worried about, but I would say, can you imagine work from home affecting it? So we live right by a Walgreens that we just went to. Work from home or not, I think Walgreens is still going to need to be open and still have people coming into it to shop and buy things, stores. So a lot of REITs, like, that's why I like the industrial REITs. So in my sector, right, I'd work on commercial loading dock equipment, and Maurice likes store, prefer O and PLD. Is PLD Prologis? Because if it is Prologis, I don't know, but if it is Prologis, I just worked at a Prologis building, and while I'll see some vacancies, work from home isn't going to work if you're making hydraulic hoses or you're making components for a car where you have an assembly line and teams of people have to be loading trucks. So that won't be as affected, I think, as office spaces will. So I like companies that, and this is how we have to think as investors, right? We have to think forward. Can we imagine a scenario or a situation that it would negatively impact or positively office REITs. Well, then we agree. Then office REITs, I'm out. I haven't sold it yet. Realty Income they merged with REIT and they spun off ONL, Orion, I forget the technical name. It's Orion Office Properties or something like that. So they spun that off, and we'll look at the next one so you can look while I'm talking. So they spun that off, and I have a few shares that I'm probably going to sell, but it's been below what I got it for. So I may just hold that one for a bit. But yeah, I'm worried about most office REITs. I don't think, and if anything, a company like WeWork might really take a hold because people only need it for a month or something, or they don't need it for people constantly coming into that office. So yeah, I'd be worried. And I think that work from home is something that's going to stay. So that was the end of the ones that they think may be undervalued. Store Capital, again, I'm not going to bore you and read through the outlook and see exactly what they invested in. We won't turn this into the Store Capital Deep Dive Hour with your host, Russ. Take a sip of water. On the Midday Forum, thank you for tuning into the Dapper Dividends channel. NPR used to do. I used to listen to NPR back in the day. Verizon, oh boy. So these ones may be reasonably valued, and hey, I'll roll through a few of these. Why not? Again, these are all Warren Buffett companies that he's holding. And I got sidetracked. I have so many thoughts. When you hear like, oh, look what Warren Buffett or Pershing, Ray Dalio sold. It's just take it with a grain of salt because that's just on that day. So they could have bought a position 2 days before, then they have to disclose to the SEC on that day what they hold, and then they could blow out of it the very next day. And we get that information a couple weeks later, and again, sometimes a month later, we'll get that information to see what they've been doing. and they could be out of it. So don't just buy because you see Warren Buffett holds this stuff, because there's very well, we wouldn't know, but they could right now have completely liquidated their position in Verizon or Store Capital, and you go and buy because they know something's coming, and then the thing drops. Data REITs might be good for working. Yeah, absolutely. Iron Mountain, or no, IRM. It's not Iron Mountain. What am I saying? I don't know those tickers, DLR and IRM, off the top of my head. I'm sure I do. I can't think of it. Yeah, thank you for having Google and for you guys, because Maurice, go ahead and share real quick what those companies are. But yeah, data centers, yeah, we're going to need data. It's funny, with this video, it's going to go somewhere, and I was just telling my wife, like, where is this video going to be? So it's going to get stored in some server somewhere for, like, what, the next 100 years? I mean, people are uploading stuff all the time, and most of it's junk. I've uploaded some junk in the past, and part of me has felt like I should help the world and delete it, but, you know, maybe someday. So anyway, always take it with a grain of salt when you hear that these hedge funds have bought or sold something, and use it for an idea. Nothing more than to say, wow, that's really interesting that they bought this company. Maybe I should look into it. So that's kind of how I like to look at it and use it. So grain of salt, block of salt. Data Realty Trust, yes, they are, and it was Iron Mountain. I second guessed myself. So yeah, Data Realty Trust, I believe they're out of San Francisco. Company I've looked at before, and now you got the gears turning. I think I might look into them. We'll pull them up real quick before we get out. Don't let me forget. We'll go through a few more, and then we'll look and see what they give DLR and Iron Mountain. Verizon, again, Verizon. I've done a bunch of videos on Verizon. I think they're great. Not buying them for the growth, buying it for the dividend. The high dividend, currently 4.82%. Simply Safe gives them a score of 87, so a very safe dividend. They have been growing it for a minute. Let's see again, the dividend growth. There we go. 30 years of uninterrupted dividends, and they have a 14-year dividend growth streak. So just very slow growth, very consistent. They have a ton of money coming in. Verizon, not something to worry about. And then because we're all hopped up on this share buybacks, let's see. Shares outstanding. Look at that. They have slowly been increasing, and it's been steady since 2019, but 4.14 billion shares outstanding, and then I like my ICR. I'm a little weird with the ICR. I always want to know that they can cover it. See, 8.87 and above 4 they recommend. So they have $8.87 of operating income to cover every $1 of interest expense. So not a problem for Verizon. I like them. 2% though, so they're growing that dividend slow. So you're buying it for the yield. I'm buying it for the yield, not buying it for any kind of growth. And it's just that way with AT&T as well, which I am excited about because of the merger that they did with, my 19-year-old geriatric cat is confused and behind me. But who we got next? I'm giving the information away. Mastercard, much like Visa, a lot of the same thoughts. The DeFi movement, I could see a day when it upsets it and displaces them. Again, 0.55% dividend yield. It's just, I'm nervous about the big credit card companies, and the yields are so small that I'm just going to stay out of the credit card companies. But their current dividend yield is 5% above their 5-year average, and because we should check, why not? Let's see if they have been buying that dividend back. Or buying the dividend back. That would be terrible. Shares outstanding, check that out. So they had 1.28 million shares outstanding in 2011, down to 996 million. So that's why their share price is constantly going to keep going higher, because they just keep buying those shares back. So there's less shares to spread the earnings out over. And yeah, so hey, great if you bought in then, but it's too small of a yield. 99 safety score. Chevron, have been buying Chevron and Exxon. The current yield, 4.22%. Dividend is 4% above its 5-year average. One thing that I love about the big oil companies, why I kept buying Chevron and Exxon, is they're fully integrated. They're vertically integrated, meaning that they are part of the the downstream, midstream, and upstream process, meaning that they are drilling it, they're extracting it from the earth, they're exploring for it, so they're drilling it, pulling it out of the earth, and then the midstream process, they are processing it, they're transporting it, so they're moving it through pipelines, through tankers, obviously the Exxon Valdez. I was younger when that whole tragedy happened, horrible thing. It was in the Gulf of Mexico, I think. So the Exxon Valdez, they're transporting the oil, the crude, and then they're processing it and they're refining it and bringing it to the pump and selling it as the petrochemicals. So really, I like to buy those companies, and there's a few of them out there. So in tough times, so if drilling gets hit or exploration gets hit, companies that are only involved in that are going to get hit pretty hard, and they're going to have a severe impact, where the other two, Chevron and Exxon, are still going to have the refining process, they're transporting. So it will affect them, but not as much, and it creates buying opportunities for them to pick up the pieces and get some of these ancillary components in the industry at a really, really cheap price. So 65, they give their dividend score, safe dividend, 3.9% slow yield, and I do believe that they are buying back those shares. Let's see what you got. We'll just go through this quick. Oh, look at that. They increased from 1.87 billion to 1.92 billion, but I think oil's going higher. I read a report from AAA. They don't expect travel to really cut down, and they're just going to keep cranking out. And I know I can see, now we just said, I can see a day where EV knocks out oil, but it's going to be a long time. You have to think of all the diesels, trucks, the planes. There's so many. Oil is intertwined in so much of the world and products in the world, which is one reason I love investing in LyondellBasell, because they have like the polymers and the olefins. I think those are the words that my brain remembers, that they're using petrochemicals to create plastics, basically. And look around you, how much plastic do you see? Plastic's everywhere. I don't know if plastic is ever going to go anywhere. I think it was George Carlin that said, don't worry about plastic. It might have been, maybe the planet created people because it needed plastic and it didn't know how to make it. So it created people to make plastic, and then it's going to kill off the people once it gets its plastic. I love it. Thoughts he thought about when sitting in the dark and when the power went out. So Chevron, not worried. I think it's going to be decades before they are so severely impacted. And they're changing too, right? Exxon with engine number 1, they had those three activist investors come on the board and really try to get the whole ESG movement going from within. And we'll see. It could be for the better that they change things. I think there was a couple more. Globe Life, not familiar with Globe Life at all. They are a life and supplemental health insurance company. 0.78% yield, 92% dividend score. Again, maybe if you're buying millions of dollars of shares worth and it's very cheap. So actually, let's look at the 52-week range. See, $100.99, really toward the high end of the 52-week. So that doesn't do anything for me. But Globe Life, again, we don't know everything. There's thousands of companies out there. Bank of New York Mellon, the dividend yield is 0% below their 5-year average, 2.38%. So he likes the banks. I know this is one of his bigger positions. And interesting, they give it a borderline score of 55. Who else do we got? Johnson & Johnson. I love Johnson & Johnson. I'm just looking for them to come back down. Their 52-week range, though, is, let's see. I should know it off the top of my head. Again, look at that beautiful chart. They have been increasing that dividend for 58 years, as you can see, the consecutive dividend streak, and $1.06. So they're getting ready for what should be in June, another dividend hike coming up, announcement from J&J. And the 52-week range right in the middle. So it doesn't move a lot, 153 to 179. So not a bad time to maybe pick up some J&J. Yeah. This guy's crazy. I know. Kraft Heinz, 4.32%. I just did a write-up on Kraft Heinz with the hot sauces for the blog, dapperdividends.com. I got a few articles I'm putting up over there. So check Kraft Heinz out, 4.32%. Now they give it a 50, so borderline safe. So that's kind of cool well, they haven't grown the dividend. It is, let's see, I think I click here to see the dividend. Yeah, so that, I think that was the cut right after they bought. They had not paid it, then they reinstated it, and it's choppy. It's a little bit risky, Kraft Heinz. And yeah, I don't know. Anybody still invested in Kraft Heinz? Jesus, there's a lot of them. All right, we'll go through these faster because you got stuff to do, right? Mondelez, 66 safe, 2%. Mondelez Consumer Staples, I think they own Cadbury, things like that. Bank of America is 1.87% dividend yield. So reasonably valued, 8% below its 5-year average. So again, you know, I'd like to see it above its 5-year average. So it's, too many banks. And then we'll just run through. He's also got AbbVie, Kroger, Coca-Cola, Aon. These all they're calling overvalued. Procter & Gamble, I love. Marsh & McLennan, American Express, Moody's. Moody's, I like. Solid company. There's really only 2 companies that do what they do, but again, such a small yield. And Costco, UPS, toward the end, Wells Fargo, and Apple, which Apple has a very safe dividend score because they could buy some small countries. So let's take a peek real quick here for Marcus at, let's look up Data Realty Trust. Why did that pop up? Digital Realty Trust. Did I say data? And let's see here. 94. Nice pick, Marcus. 3.6% dividend growth yield, so it's a little bit slow. 2.99%, which is below their 5-year average. Curious what's going on with that, why it's below. Well, obviously, I know the prices run up, but all right, cool. Looks like they've been growing that dividend since 2003 with no cuts. 16 years of consecutive increases. That's my text message going off. $1.16. It's okay, my wife. $1.16. Not bad. Let's just really quick. All right, right in the middle of the 52-week price range, 125 to 176. And again, they were a REIT, right? Those dividends aren't, non-qualified because they are a REIT. Quarterly REIT, or quarterly dividends. AFFO, 76%. Or free cash flow payout ratio, I'm sorry. There it is, the AFFO payout ratio. Nice, below 90%. So, okay, cool. Well, this looks like an interesting company. And again, see, this is, so yeah, we like to see shares outstanding coming down. But again, when you have REITs, they're issuing more shares to bring in more money, but then they're reinvesting that money to grow the company, and they're not using it for crazy things or just because they're burning through cash. Like, that's why so many of these companies are really getting hit hard by rate hikes, because money is not going to be as cheap, and they're not self-sufficient like big, successful blue chip companies are. And what about our shares? Yeah, we just looked at that. So yeah, but nice up and to the right. Their outstanding shares are growing to 282 million, but their sales are also growing up and to the right. OHI, I can. Let's look at it. Let's take a peek. Omega Healthcare Investors. Now, I do hold them inside of, I'll show you in a minute here. I'll pull it up. 40. Yeah, you know, it's interesting. I guess I was doing a little bit of yield chasing on that because the yield is currently 8.82%, which is high. And here we go. I have 107 shares that are inside the self-directed IRA, and you can see I'm down $677, which I'm hoping that over the long run we have so many baby boomers that are retiring and they need health care. It's only 2.7% of that portfolio, which is not a problem. And again, my mindset is I'm holding this for decades, has some COVID risk, but coming back, it does. And it has been coming back. I noticed that. Now they got a long write-up on it. We won't go through. So it's cool. They put out these notes every few months, and they either, so if they cut or they don't, I guess they say why. That dividend growth has been growing since 2002, so I'm hoping that they can keep that going. When PEP hits new all-time high. Yeah, Greg, that's 100% correct, because I forget how many times I've been buying Pepsi at the all-time high. I keep buying. It's probably been a dozen times. I'm sure I can find that information somewhere. OHI, last 20 years, 5% average dividend growth. So not bad. The payout's 67. So it's been flat since November. They're going to have to raise that sooner. They're going to lose that streak of 17 years. And, price to AFFO yield. So we're close. We're coming back. So it doesn't move a lot, $27 to $39 in the 52-week range, and it's at 30. So we're still obviously toward the lower end. And compared to the other REITs, it's well below. Let's see if we can see here what's going on with their earnings. So their adjusted free cash flow payout ratio, that's why they give them this, because they like to see under 80%, and they're at 87 or 84 for the last 12. So this is why Simply Safe Dividends is worried, because their payout ratio is a bit high. But check that out. In 2018, it was 98%, 96. So it's come down, which is what we want to see. That's a bit high. The free cash flow per share, though, $3.26. And what was that payout again? Total $2.68. So they got $3.26 of free cash flow per share. So I think they're able to. There's oil and Pepsi. It's still going up even with the markets down a bit. Hey, it's been crazy. Every day I'm like, yes, the market's down. It's a big red day. And I look at Pepsi. No, it's up. The damn thing just will not go down. I know what they're doing. They're waiting for me to buy that 100th share, and there's going to be a 20% drop to below my average. My luck, what'll happen. So, sales growth. So really choppy, negative in 2018 and 2020. Sales growth for OHI. They've been increasing these shares, but I know they're trying to. I believe they're in England. They have some facilities in England. And they've been trying to expand internationally, which could be good if they're right there. If they're issuing shares, getting more money to try and expand into foreign markets, then that is a good use of the money. And it's risky, but it's not just money's being spent on stupid stuff. I was going to say cocaine and hookers, and they're going into debt to pay that down. But hey. We want to see that money, that capital allocation, used to productive measures. So, I'm still bullish. Their interest coverage ratio, and this is usually, it's funny they put it last, because this is kind of like my last line of defense. As long as they are able to pay the interest on their debt, then that's what I'm concerned about. And we can see they have $2.70. Which they would like to for see, that's cool. They have 2 for senior living REIT. So, I'll let you know, Marcus. I will let you know. All right, anybody want to look at anything else? You want to look through my portfolio again? Here, why don't we do this? So, let's go to portfolios. I have my kids' ones in here, but we'll do the bridge. And so it's kind of cool. We can do the same thing, this timeliness, just like Buffett's portfolio. So for my portfolio, the bridge right here, they're saying undervalueds are Leggett and Platt, which they're good. Lockheed Martin, we got 10 shares. That was my target. So I have a silly thing. No matter how expensive a company is, my target is always 10 shares. Like that's kind of like my motivation for my starting position. So Lockheed, we got 10 shares. And then 3M, they think is potentially undervalued because the dividend yield is 15% above the 5-year average. So that's Ned. All right, Maurice, we'll look at it. There's Gilead. And then you want to see the big one? Here, I'll share it all. Let's go down. Simon Property Group, that's the last REIT that I hold in this bridge, which is taxable. And where's T? It's at the, oh, there it is. 142 shares. Now, you know, I bought it. I went all in when it was in the high 30s so I could sell covered calls. And, yeah, it appears speculative. Where it doesn't show what I'm down on. I thought it would show the percent I'm down. I didn't put that in. Anyway, let's get to Marcus. It's a bunch because my average is 35.23. So, you know, it's a long-term hold. He wanted Med. Oh, Medtronic, right? Oh, Medifast. Interesting. 45. Interesting. 45 borderline safe. 26% dividend growth in March of 21. So they're coming up in a couple months on another growth, 2.96%. They manufacture and distribute weight loss, weight management, healthy living products, and other consumable health and nutritional, blah, blah, blah. I just saw pudding. Pudding. Medtronic. Medtronic is solid. They're on my watch list. Yeah, I don't know Medifast, but it looks like they have weight loss stuff. You know, that's something that they teach is that people are always, no matter the market, if there's a recession, people are always interested in their beauty products, how they look, which is weight loss, relationship stuff. So if you're looking to start a business and get into relationship stuff, people, you know, you could be poor. Poor people still need to find love too. Sin stocks. So people, hey, you know, they still want their cigarettes and booze, I guess. Apple. I sold Apple because I think it's a bit overvalued. Great company, but I'd love to get it at a cheaper price. And I did that starter position at 146, and within like a week and a half, it was at 176, 180. So I sold it there. All right, let's just finish through this. Wow, look at that. That's a steep slope up from 2014. So 5 years dividend growth streak. And let me take a quick peek at the financials here. Oh, look at that. 192 bucks. I'm going to guess. I've never looked. I'm going to guess they have a little bit of, they don't have a lot of shares outstanding because I can't imagine a weight loss company being $192 a share, but obviously they're at the buried at the lower end of the 52-week range. Newer company, I'm guessing, because it doesn't look like there's any information before. No, I guess not. They might not have been making any money before 2015. That's what I am guessing. Yeah, I'm wrong. Shows what I know. I don't know why they don't have any data there. Interesting. Sales, 68% growth. Okay, so earnings per share has been nice and up since 2016. There it is. Yeah, 11 million shares. So that's why it's so expensive. They keep buying back shares. They don't have a lot. Let's take a peek at, we'll go to Med. Interest coverage ratio, 1.51 in the thousands. So they're okay there. Big, huge. That's maybe the biggest ICR number I've ever seen. That's really interesting. Why is that right? That can't be right. 1.51K. So they have $1,510 of operating. So they have $1,510 of operating income to cover every $1 of interest expense. Mind-blowing if that's right. So they have no problem there. That's weird. That doesn't seem right. All right, let's look at Medtronic. If you want to ask me anything, go ahead. Shoot me. Whatever. Oh, yeah. So this is a company I don't own, and this is probably going to be on my top of the tippy-top buy list when markets, if they ever crash. I know we got a significant pullback here. Yeah, 99 dividend growth, 8.6%, so that's fast. 2.39% dividend yield. Nice. They increased in May 22nd, 2020. They increased the dividend 7%, so that's a bit of an old note. Let's see. During the recession, their sales were up, but their overall return was down 56%. They increased the dividend during the recession. And 43 recession. I like that. That's like when you're stressed out during the recession. It's a recession. We need some recession exercises. 43 years dividend growth streak. So 7 more years, they will be a dividend king. And yeah, that is very nice. They've really ramped it up here. Cool. I think that looks good. 13% average the last 20 years. And currently 63 cents a share. You know, that's not looking too bad. They say Medtronic is 2.39%. The current yield is 11% above the 5-year average of 2.14%. And look at that. Hey, you know, that's interesting. Way down toward the lower end of the 52-week range. So, hey, I might have to pick up some of this. You know, we'll be looking. Oh, another thing I don't do, I don't like to buy fractional shares. I don't know why. I just never have. So you'll always see me buy a full share, and that's probably something I should change, because if I don't have the cash in there, I'll just wait for it to build up and accrue. And let's see how they've been buying back shares. Free cash flow payout ratio, not bad. The earnings. So I always like the free cash flow payout ratio over the earnings payout ratio, because the earnings payout ratio can be manipulated. It can be massaged by accounting shenanigans. So with like EBITDA, the depreciation and amortization, those are actual costs of the business. So I know Warren Buffett, again, doesn't like these. Why are you? So EBIT is a better metric to go by, because that would give an unrealistic number. So the earnings before interest and taxes is more accurate to look at. So EPS, I always like to use free cash flow over that. And the free cash flow per share, $4.29. Yeah, let's see if they've been buying back shares. Shares outstanding. So look at that. They had a jump in 15 to 16, and they have been slowly buying back, but they did increase a little bit. So 1.36 billion in the last 12 months. Free cash flow margin, 17%. That is stout. Operating margin, 22%. That's good. Yeah, Medtronic, solid company. I know they're kind of a dividend darling with good reason. There's that ICR, $12.37 to easily cover every $1 of interest expense. So why don't we do this? Anybody got any more questions? Let's see how long I've been blabbering on for. So check this out. I think I couldn't figure this out. Whoop. Make me big there. Hi, how's it going? Wait, what am I still sharing? Oh, watch this. I don't know what I did. Oh, I took myself away. I don't know what I'm doing now. This guy's gone crazy. Here. Whoop, there I am. So, I'm learning these hotkeys. Hello from OBS Studio. Hello, everybody. How are you doing? So, anyway, what do you guys want to know? Ask me something. Give me a question. Tell me something. What do you want to know? What do you want to hear? You want me to look up something else on Simply Safe dividends? I got snow to shovel in a bit here. It's already noon. Jeez Louise. So I'll probably wrap this up, and this will be my video. Uh-oh. What happened? What did I do? Daddy broke it. Here, like this. There we go. I think I had myself like there, so I didn't interfere with any of the... Yeah. Well, all right, everybody. Thank you for watching. I'll give it a second here because there's like a little bit of a lag. Anybody still out here? Yes? No? Look at that. Whoop. I can watch myself shrink it back. Nice. 8 concurrent viewers. So, hello, whoever just popped in for the 8th viewer. If you have a question, I'm about to sign off. Let me know. We're not doing the telethon here. Crypto Dividend says thanks. All right. I got snow to do, snow duty, and then we're going sledding with the children. So this was fun. If you like this, if you watch this later, I'm going to have it up as a video, I think. I should be able to figure that out. So let me know. Yeah, I could do this again, pick up a theme and share something. I don't know. We'll figure it out. Maybe just do some question and answer. Come up with a theme to do. So anyway, I do appreciate all y'all tuning in. We're going to end it, and watch me now. Watch me go. I think I hit end stream, so peace, everybody. Let's do the salute, and I don't know how this works because it's my first live stream. So if there's a video up here, check that video out. And I will, I will talk to you there. Peace. Yeah, end it. End it, YouTube.